Assalamu alaikum and a very good day. My name is Chaudhry Muhammad Aziz Anwar. I am presenting my APEL-C challenge test demonstration for financial accounting and reporting 4. Today I will discuss the application of international accounting standards with example from my professional experience. The focus will be on four important standards: IS 21 foreign currency transaction, IFRS 2 share-based payments, IS 19 employee benefits, and IFRS 8 segmental reporting. IS 21 foreign currency transaction. IS 21 guide us on how to account for foreign exchange differences. When a company records a transaction in foreign currency, it must use the spot exchange rate on the transaction date. At the reporting date, monetary items like receivable, payables, or loans are translated at the closing rate. If exchange rate fluctuations occur, the differences are usually recognized in the profit or loss statements. However, if the differences relate to a net investment in a foreign operations, then they are recorded in the equity and other comprehensive income. Let me explain with an example. Suppose a company purchases a raw material from US supply for $50,000 at the invoice date when $1 equals 1.1 local currency. The company records 55,000, but when payment is made later at the new rate of 1.2, the company actually pays $60,000 in local currency. This additional 5,000 local currency is recognized as an exchange loss in the profit and loss account. This demonstrates how exchange differences directly affect the financial results. IFRS 2 share-based payments. Moving to IFRS 2, which governs accounting for equity-based compensation such as share or stock options granted to employees. The key rule is that expenses must be recognized for services received, measured at the fair value of the equity instruments on the grant date. This expense is spread over the vesting period. If equity settled, the amount is credited to the equity. If cash settled, a liability is recognized and remeasured at each reporting date. For example, if a company grants 1,000 stock options to employees with a fair value of $10 per option, the total expense of $10,000 is spread over 3 years vesting period. That means 3,333 is recognized annually. In my practical experience at Footwear Private Limited, the company applied this standard by gradually recording the expense as employees rendered their services. At the same time, equity increased to reflect ownership rights. This approach ensured both accuracy and fairness in reporting. Next is IS 19, which covers short-term post-employment and other long-term employee benefits. Short-term benefits such as salary and how bonuses are recognized when services is provided. Post-employment benefits such as pension may require actuarial valuation. Termination benefits are recognized when company commit to providing them. Let me explain. At Onsol Private Limited, the company provided a defined contribution plan by contributing 5% of employee salary for a year. This amount to $50,000, which was recognized as an immediate expense in profit and loss. Since this was a defined contribution plan, the company had no further liability after making the payment. This shows the standard's simple but effective application. Segmental reporting. Lastly, IFRS 8 required company to disclose operating segments based internal management reporting. The purpose is to give investors transparency on how different segments perform so they can better understand the risks and opportunities. For example, consider a multinational company with three segments: North America with $2,000 million revenue and 40 million profit, Europe with 150 million revenue and 25 million profit, Asia with 100 million revenue and 50 million profit. In conclusion, the application of these standards IS 21, IFRS 2, IS 19 and IFRS 8 provides user with a true and fair view of the company financial position. They ensure comparability across industries and countries, improve transparency and increase investor confidence. Thank you so much for your attention.